My next guest is an Australian economist who was one of the few economists to predict the global financial crisis back in 2008 and the recent Chinese debt crisis. He is basically the Edward Snowden whistleblower for the banking finance industry as well as the economics profession. He is the author of the book Debunking Economics, The Emperor Dethroned, which came out in 1999, and is currently the head of the School of Economics, History and Politics at Kingston University in the UK. I'm talking about Professor Steve Keen. Welcome to Project Civilization.
Thank you, Marcus. By the way, there's a second edition of the book that published in 2010, and you can see the cover of it behind me. So that's not quite as out of date as the first edition, but it needs an update.
Fantastic. Okay, so Professor Keen, it's been quite a long time now since your book was actually published, which goes to show the craziness of how our current banking system works in terms of equilibrium theory being complete rubbish, among other things. And now, here we are 8 years after the last global financial crisis. There seems to be little reform done, and the global economic system looks like it's in the same state now as the Costa Concordia was when Captain Schettino decided to abandon ship and leave the passengers to drown. So, global debt has risen substantially, with Europe and Japan in negative interest rates. Janet Yellen was in Washington, D.C. just 2 weeks ago saying the Fed would look at negative rates in the spirit of prudent planning in light of the European experience. This seems illogical given the strength talk they had been pushing when they raised rates marginally into weakness back in December. So the US hasn't reached escape velocity. Meanwhile, commodity prices have collapsed and gold is on the rise. So my first question to you, Steve, is what the hell is going on? Is Australia and the world already in a financial depression?
Yeah, we entered a crisis in 2008, and in the aftermath of the crisis, we haven't escaped it. It's a bit like we've hit the iceberg in the Titanic, managed not to sink, but the iceberg is still on top of us. So we haven't got out of the crisis at all, and the economists and their policies to try to evade it are people who are trying to evade a crisis they didn't think was going to happen, and they don't know what caused it. So their interventions have made a system messier. They certainly haven't ended the problem. They've just added other complications on top of it, with negative interest rates being the next stupid complication they're going to add.
So why hasn't this been broadcasted more on mainstream media?
We all tend to accept conventional wisdom, whatever that might be. So if I asked you, say, 600 years ago, why do the planets move the way they do in the sky, you would have given me an explanation based on Ptolemy's theory of astronomy that said, oh well, there are these spheres on which the stars and the moon and sun and the planets rotate, and the ones that the planets are on, they've got other little spheres on spheres, and that's why Mars moves the funny way it does in the sky. And you would have been using the best intelligence of the day in which you spoke. So it's not your fault you're spouting complete rubbish. Okay. We then know, courtesy of Galileo, a couple of centuries later, and Tycho Brahe and Kepler and a few others, and ultimately Newton, that the planets and the Earth and all orbit the sun. The stars are other suns enormous distances away, and we're following the law of gravity. Now, in fact, economics effectively is living before the discovery of gravity in its own profession. So people in the public and the newspapers will spout what they think is intelligence they've learned from swallowing economics textbooks, or swallowing what they hear from politicians in an informal way. They've also swallowed the textbooks, and they're spouting complete rubbish. Not their fault.
Gosh, yeah. Looking locally now to the Australian economy, there's been a fresh spate of mainstream media activity discussing the possibility of a housing bubble. So, Steve, does Australia actually have a housing bubble? And if it does, is there any chance whatsoever that you could be wrong?
Categorically, we're in a bubble, and No, I'm not wrong about the existence of a bubble. I could be wrong about the timing of it bursting or whether it will burst, but categorically we're in a bubble in Australia. And the reason I can say that is that I can argue from logic of how where demand comes in buying housing, that what actually causes rising house prices is accelerating mortgage debt. We have both accelerating mortgage debt and the highest level of mortgage debt compared to GDP in the world. So we've got to, if knowing what the cause of bubbles is, and this applies in every economy I've looked at with one exception, and it happens to be Ecuador. The driving force behind house prices is accelerating mortgage debt, and that because if you're accelerating, ultimately your level rises faster as well, and that therefore means you normally have a crisis when you have an excessive level of private debt. That's what caused the subprime crisis in America and so on. And we are far, far more in debt now than the Americans were at the peak of the subprime crisis.
So if you're right and house prices do correct, where do you think they will ultimately end up and roughly what time period?
Well, the time period is the problem because there's a couple of things that keep prices alive in Sydney in particular and then spill over the rest of the country, and that's the fact that foreign buyers are allowed to buy as much property as they like. I mean, the government's cracked down on that finally just recently. That's taken a particular potential source of additional demand out of the equation. If it wasn't for that, we would have crashed in the last year or so. I can see prices. I said back when I first was asked about this and got myself in hot water with Australia's lovely and friendly and understanding and intelligent and reasonable property lobby, that something of the order of a 40% price fall is quite feasible. And I still think that's going to potentially happen, but it can be delayed by continuing to encourage people back into mortgage debt, and that's how we've delayed it so far. So the Australian house prices began to fall in 2008, and the Rudd government response, as well as a stimulus package that I thought was a sensible response to the crisis when it hit, also doubled and trebled the first home owners grant, which I call the first home vendors grant. And that restarted the bubble in the middle of the crisis, which is why Australia didn't delever and therefore didn't have a decline at that time. And then when that particular government intervention ran out in 2010 and house prices started falling again, the Reserve Bank's response when the economy didn't experience the inflation they thought they were fighting off, and they'd put interest rates up dramatically, of course, after 2009, unlike every other central bank in the world virtually. They were forced to reverse direction, and they reversed direction with the hope that that would trigger people to go back into the property market once more, which it duly did, because by this stage retirees and so-called investors were scared off the stock market, and they would pile into the property market as the only place with positive returns. And what was a restored bubble in 2008, courtesy of first home buyers being dragged in, became a restored bubble in 2012 with so-called investors piling in. And the end result of that, as I've said, is we have a higher level of mortgage debt now than America had at the peak of its crisis. And mortgage debt in Australia is about 1.5 times as high as mortgage debt in America right now.
So to me, it seems extraordinary that you're more than qualified to speak about how to run an economy correctly, and yet we have contradictory views from the government. Only last week, our Prime Minister went on a fear campaign saying that under a Labor government, house prices would fall. So aside from bubble-like conditions, are falling house prices generally a good thing or a bad thing?
Well, house prices should be something we think about in the same way we think about carrots. And nobody goes on the news and say, fantastic news, carrots have increased by 10% in the last year. Fundamentally, housing is a consumer item. And if we turn it into a speculative item, then the real beneficiaries of that are the handful of people who are mass speculators, but mainly the banks, the real estate agents and the media, because they're the ones who make money out of the turnover of housing and the increased cost of housing. So it doesn't benefit us at all. We really should have stable house prices. Roughly, house prices should be regarded as a consumer item in the same way we think about stuff we actually buy and consume on a daily basis. So it's a myth to regard rising house prices as a good thing. But that we've got caught up in that myth, unfortunately, and that really dominates the Australian psyche these days, as it did the Irish psyche, I might add, before its bubble crashed and brought the economy to the ground, and the Spanish economy, and of course the Americans back in the subprime bubble.
So how likely would it be that as a result of house prices falling, the Australian banks will fail to some extent where they would need to go into external administration. Would this lead to a falling Aussie dollar? Would this be good for owners of gold and silver, which are priced in US dollars?
Oh, well, if you have a debt crisis, always it brings the banks unstuck, because their solvency depends upon people being able to repay their debt. And if people can't repay their debts because they were basically involved in a Ponzi scheme, and the only way they could repay the debts was by selling a property for a higher price, if they can only sell it for a lower price, then they can't repay the bank, and the bank has to use part of its equity to make up for the loss in the value of its assets, and that can make the bank bankrupt. And that's what happened. Every bank in America was effectively bankrupt during the subprime crisis and rescued by the government. The Australian banks were also rescued at the same time, a lot of them by the Federal Reserve. If you look back and see what happened in 2008, our banks were bankrupt a lot of them were bankrupt back then, and only saved by the government bailouts, including bailouts by the Federal Reserve of banks around the world. So yes, if it happened again, they would be fragile. This might sound extreme, but if you take a look back and look at Japan in 1990, Japan was the global booming economy at the time, and 9 of the world's 10 biggest banks were Japanese. Now none of them are. So when all your banks start turning up at the top of the valuation list of global banks, you know you're ready for a crisis. And I think now 3 of Australia's banks are in the top 10 globally. I think it's a very good sign that we're heading for a fall.
Now, I'm no economist, Steve, but on the street, it seems to me like the Australian economy is totally upside down right now. The productive people in business are doing it tough, and yet the property speculators and landlords are having a wonderful time. They're making heaps of money in their sleep. And if you follow the money back to the source of where it's created, you can see that the majority of the banks' balance sheets are in home loans. So shouldn't the banks mainly be lending to businesses like they used to? And how should a healthy economy actually function compared to the way that it is now in terms of bank lending practices?
Yeah, now banks, the productive role of banks is to lend working capital corporations, debt to consumers when there are consumer items they need to buy that they have to go into debt for, and houses and cars are in that category because they're just too big for most of us to buy for outright for cash. And then money for entrepreneurs, people who've got a good idea but no money, and making it possible to turn that idea into an actual product and then sell it. That's the creative role of banking. And if they did that, they'd still need to write debt off on occasions, and we'd still need government money creation to enable that to happen. But we wouldn't have a totally useless speculative bubble, which is what we have these days. So rather than providing working capital to firms, most large corporations issue what they call commercial paper these days to get the cash they need, because the banks make it too expensive to have a line of credit. Banks don't lend to entrepreneurs because they're worried about losing their money. 4 out of 5 entrepreneurs are going to go bust, and so they don't lend to entrepreneurs at all. And then finally, what they do lend to is speculators, because particularly in housing, they have the same myth that the people borrowing the money have, that the houses are as safe as houses type argument, and they lend and finance speculative bubbles. So the creation of money is actually mediated through speculative bubbles, not through productive enterprise. So we are completely arse about tit on that front.
Gosh. So some people I talk to feel quite confident at the moment because there's been news that the major banks have now issued new stock, which has raised more than $15 billion from shareholders in 2015. Is this kind of action enough to protect the banks from any future economic shocks?
No, because they've still, I don't know what the leverage factor is for Australian banks these days, but if you look at what happened back in America, the leverage ratio became roughly 30-1. So the level of loans was as high as 30 times as the equity of the banks. Now that meant that a 3% fall in the value of the assets, which is a trivial decline, could wipe out their equity. And that's what actually happened. The fall in the asset valuations was the order of 20%. With the decline in house prices and the crash in share prices. So with that much wiped out, the banks were completely bankrupt, and they had to be bailed out by the Federal Reserve and the American government to continue operating. And even in that situation, hundreds of banks, thousands of banks actually folded in America, and several of the major institutions went down, Bear Stearns and Lehman's and so on, which, by the way, those same institutions survived the Great Depression. So it gives you an idea of the scale of the crash we had this time around. It was actually bigger. in terms of a financial shock than the Great Depression was. So they're not safe. You can only protect yourself when you do that sort of equity raising. You're protecting yourself against what I call episodic events, the individual isolated cases of people going bankrupt. You can't protect yourself against systemic crisis where the whole place slows down because of the deceleration of the growth of debt and the realization that a large part of our money is running through a Ponzi scheme. When the Ponzi scheme stops, there's always a deficit.
Right. So Lindsay David, in his book Australia from Boom to Bust, said that our Aussie banks are essentially insolvent, and that this reality has been hidden due to the borrowing of capital from the international markets. Is this actually a fair assessment of the situation?
I think so. I mean, again, the books of the banks are going to look great until after a crash, and this is one of the errors. I mean, I get people telling me very sagely that I make a mistake in comparing debt to GDP because that's comparing a stock to a flow, which shows they know nothing about dynamic analysis. But they then say, well, you shouldn't be comparing debt to income. You should be comparing debt to assets, and as if the assets are independent of the level of debt that's been taken out to buy them in the first place, which unfortunately is equally nonsense. The valuation of the assets is determined by the level of leverage. So if the level of leverage rises, the asset price rises as well, and the ratio looks like it's healthy. When you have a slowdown, the level of leverage still remains there, but the asset prices can plunge because what we're actually selling is just a fraction of the total value of assets. With the way we value them is by multiplying the total amount of assets available by the last sale price on average of assets. Now, if we all tried to sell our houses at once, house prices would collapse. The reason house prices remain high is that only a fraction of the housing is actually sold. But what we then do to value the housing stock is we take the price that fraction sold for and convince ourselves that the entire 100% of houses could be sold at that price. No, they can't. So what you get is incredible fragility in asset prices when there's a change in the rate of financing for them, and they can just collapse overnight. And that's so that you could look at the books of the banks right now and say, okay, look, they look reasonable. The asset side and the liability side, you look at the two, and there's a gap between the two, so the banks have got positive equity. But if there's a collapse in asset prices, then very rapidly the assets can plunge in values, the liabilities remain the same pretty much, and the banks become bankrupt.
As I mentioned at the beginning of this video, we've recently seen the US Federal Reserve increase the effective funds rate to a measly 25 basis points.
Yeah.
What does this say about the next 12 months for the world economy? Should people do what the legendary commodities investor Jim Rogers says and sell everything and head for the hills?
I think that's extreme, but it certainly indicates that the Federal Reserve hasn't got a clue of what's going on, because they have this. The reason we get such nonsense in economics is that in economic policies, economic theory itself is nonsense. And if you look at the models that economists build, they leave banks, debt, and money out of their equations, and they leave non-equilibrium events out as well. So you're modelling a world where there's no money, no banks, no debt, and no disequilibrium forces. Well, that's not the planet we live on. So when they make a decision, it's about how do we restore equilibrium in our models. And as I argued in one of my Forbes articles about a year or so ago, you can understand, just understanding four or so numbers can explain economic policy to you. Economists, mainstream economists, think the interest rate should be 2%, the inflation rate should be 2%, the growth rate should be 3%, and the interest rate should be 4%. That's their little set of numbers. And so all their policy moves are trying to get back to that, what they see as equilibrium situation for the economy. So the Reserve thinks it'll get things normal when they've risen rates back to 4%. Now, what they don't realise is that if they push rates up, particularly even like of the order of 1%, that is going to mean that people who are currently continuing to borrow, increasing their debt levels, will decide not to borrow money anymore and stop increasing the money supply as a result, and the economy will tank. And that's the feedback from the major source of additional demand is new debt. Pardon me. So if you go from expanding debt to contracting debt, you go from expanding economy to contracting economy. And the Reserve is likely to trigger this by putting rates up. Mind you, I don't think they're going to go particularly far. The economy is far more fragile than they realise because they ignore the level of private debt. It was 1.7 times GDP in America back in 2010. It's now 1.5 times GDP. That's still, when you do adjusted figures for how the stats are kept now versus back in the 1930s, that's still beyond the highest level that private debt reached back in the Great Depression. And because the mainstream economists ignore that number, don't think it matters at all, they're not worried about putting up rates up. And of course that's wrong. Their attempt to put rates up will cause the economy to go down. So I think it's not necessarily time to run to the hills, but it's certainly a time to not trust asset prices.
So given the current state of the US economy and the fact that they're going into an election cycle later this year, combined with the reality that the Fed chair serves at the president's pleasure, could we expect to see any more quantitative easing or any other monetary trickery this year?
Oh, we're bound to see monetary quantitative easing come back in again, because that's what I've called that a pact with the devil in one of my Forbes articles, because what that's actually done is inflate asset prices. They think it's inflated asset prices by encouraging people to get out of riskless assets like government bonds and into risky ones like the share market, because they've driven down the return on bonds, and they think, well, that's a price effect, and therefore because the prices of assets go up, people will feel wealthier and spend more money, and that'll stimulate the economy. That's the half-assed logic behind their thinking. In fact, what's happening, yes, that's part of what also happens, but the major thing that happens is when you buy, as particularly happens in English QE, if you buy bonds off pension funds and insurance companies, then they will go and buy shares with that money, because you've taken bonds off them which earn income, you've given them cash which doesn't earn income. Their responsibility is to invest what they've got to try to make a profit. They will then buy shares, driving up the price of shares. So there's a very direct link between QE and rising share prices. Now, when the government decides not to run QE, suddenly a major source of the demand that the pension funds and the insurance companies are making for shares, and banks themselves buying back their own shares on their own asset side, that disappears. So a huge factor that actually causes the asset price to rise, which they thought the government, the central bankers thought was a good thing, evaporates, and they'll be forced back into it again. And that's partly where we're seeing this huge volatility on stock markets this year.
So on a slightly different tack now, superannuation funds, are they essentially overvalued Ponzi schemes with capital that could evaporate when the baby boomers draw down in their retirement?
Yeah, I mean, the whole idea of superannuation was to both to give replace the pension, which I don't think was a good idea at all, but also to enable infrastructure investment to occur in Australia. And rather than building up our infrastructure using the investment money we set aside through super, it's all gone into stock market and real estate speculation. So it's driven up asset prices. It has done bugger all to improve the productive capacity of the economy. So in that sense, it's not investing at all. We use that money to speculate, not invest.
So then are superannuation laws actually a smart idea over the long term then?
No, I don't think they are. They would have been a smart idea if they were a form of sovereign wealth fund, as Norway has done, where you took investment positions in other countries to some extent, so you got an income flow from overseas, or you use that to create infrastructure and make the whole economy more productive. We haven't done anything like that in Australia, so I think in that sense it's been a con job.
So changing back to private debt, what can be done to untangle excessive private debt? You've spoken about a modern debt jubilee before. Can you explain what a debt jubilee is in historical terms and why it needs to be, as you described, a modern day debt jubilee?
Yeah, well, if you go back to the ancient Sumerian civilization, that was the first civilization to have a debt jubilee. And the logic there was that people would borrow money and go into debt obligations with the wealthy, or with the church itself quite frequently, because I'm talking a church that predates Christianity by 3,000 years, but nonetheless it's a religious institution. They'd borrow money, and then debt would be compounded at quite high interest rates, and so you get an exponential takeoff in the ratio of debt to income. And when you couldn't repay your debts in that civilization, you became a debt slave. You had to go and work on the property of the person you owed the money to, and you literally became a slave. And what that meant was, for the Sumerian civilization, their army was full of freemen. You couldn't be in the army if you were a slave. So the actual military force needed to defend the empire, and that was the world's first major empire, started to fall, and the emperor's response was to slaughter the landlord families and free the debt slaves. And after that first instance, we became rather less violent about it and instituted every 49 years, I think it was, or every change of the ruler, there was a complete write-off of debt. And that continued right through to the early Roman periods. There's in fact one of the sculptures you'll see in the Roman Senate, if you go for a walk through Roman Forum, is a frieze of the burning of the books of debt, which is a regular event in early up until about 100 or years or so BC, a regular event in Rome as well as in the Jewish areas and in Arabic civilizations and so on. That was an old-fashioned debt jubilee. You can't do that in a modern sense because in the modern world we're in debt to the banks, but there are people who individually are in debt and other people who individually are in savers. Now, for example, I've got no debt and a fair amount of money in my superannuation fund. So if you simply let the debtors off the hook now, you'd be benefiting people who speculated and levered during the boom, and you'd be penalising people who didn't. So my proposal is let's have a modern debt jubilee, and that's use the capacity of the state to create money, just like the banks can create money by lending. The government creates money by running a deficit, and they could use that deficit to make a direct injection into people's bank accounts, and that's what I call a modern debt jubilee. So you'd give to people on a sort of per capita basis, regardless of whether they're in debt or whether they have a positive savings balance, a certain amount of money. Let's say $10,000 is a nice round figure. And if you had debt, you'd be required to reduce that debt by $10,000. But if you didn't have debt, you get a $10,000 cash injection. Now, what that would mean is you reduce the level of leverage in the economy without reducing the demand. In fact, you'd increase the demand. And you actually cause some inflation, which the central banks are trying and abjectly failing to cause right now through QE. So a policy like that could reduce the level of leverage. You'd then, of course, have to change what you let banks lend money for to stop another bubble starting all over again. And I've got ideas about how you can prevent them lending to finance house price bubbles in the future. And I'd also outright ban lending to buy shares. I'd bad margin lending altogether. And I'd make it profitable for banks to lend to entrepreneurs, which we need to have them doing. So you have to make a range of institutional changes as well as just the debt jubilee. But you then need to institute a target, making the level of private debt an economic target in the same sense that the rate of inflation and the rate of unemployment are made economic targets, because the fundamental cause of our crises is having too much private debt. And for example, in Australia's case, we used to have a level of private debt back in the 1950s of roughly 25% of GDP. We now have a level of private debt of 200% of GDP. And I reckon the sustainable level for Australia is something of the order of 50 to 60% of GDP. So we have to wipe out 1.5 years worth of debt of GDP's debt equivalent to 1.5 years worth of GDP. If you do that by people paying their debt down or writing their debt off or borrowing less money than they repay every year, you're talking about a permanent economic slump. So we have to find a more intelligent way of reducing that debt, and that's why I've proposed a modern debt jubilee.
So even though a modern day debt jubilee may solve the problem today, if people believed that we were going to have a debt forgiveness every 60 years or so, wouldn't that just create moral hazard for the banks or even the debtors?
Well, that's why you've got to change what banks can, the basis on which banks lend. I don't think regulation can control the banks. They're always going to find a way around regulation. I have colleagues in the financial sector who tell me that they find it quite amusing to be invited to the Bank of England to get a briefing on the next set of proposed changes about tax laws, because they're sitting around the table nodding their heads about how effective this is going to be and simultaneously working out how to evade the law themselves when it's put into power. So regulation is always going to be too slow. But I'd change the rules about what banks can lend on and the limits you'd apply to them. So, for example, at the moment, the banks can effectively lend whatever they like to mortgages based allegedly on the income of the borrower, with the idea of a loan to valuation ratio. I would set a limit on the amount of the money banks can lend to buy an asset like a house to some multiple of the income earning capacity of the house. And that would mean, for example, let's say it's a ratio of 10. If you had a property that rented each year for 50,000 Australian dollars, then the most a bank could lend anyone to buy that property would be $500,000. Now that would dramatically reduce the level of leverage in house prices and relate the level of debt to the level of income, which is what we need to do to avoid these runaway bubbles happening. So that sort of control is necessary to get around the problem of recreating a moral hazard. But the moral hazard comes from allowing leverage to determine asset prices. That's what we have to end.
So if we fill up the government balance sheet with this modern debt jubilee, wouldn't that just rope in unborn taxpayers, or are you saying that the money is destroyed off the government's balance sheet eventually?
The money it's just a double entry bookkeeping story. It's simply a case of it's a bit like saying, look, if you get too high a cricket score, isn't that going to stop people scoring decent scores in cricket in future? I mean, if Bradman scores 500, the next, will that stop anybody ever being able to score 500 runs again? It's simply a scorekeeping system. That's what the amount of money is. So the government itself does not have, and this is the trick about a government. The government is the only institution in the economy that owns its own bank. Okay. Now, if you owned your own bank and people accepted the notes you created, you're never going to run out of money, are you?
No.
So it's okay. So it's applying the thinking that you and I have as an individual. We can't print our own money. If we try to do that, we go to jail. We're applying what limits what we can do, what we have to do for our kids in the future, to the government, which owns its own bank. And yet we're quite happy to accept the transfers recorded on the government bank's ledger as transfers of money between ourselves. So it's just a scorekeeping system. And if we set the scorekeeping system up properly, there's never going to be a problem about the government in future repaying it. The one danger of the government doing that is what it does to our foreign trade balance. And if we then end up importing too much from overseas, and therefore our currency starts to plunge, and we have to pay more to buy imported inputs we can't produce for ourselves, then you've got a problem. So there is an issue about how much the government does of this related to the trade deficit. But that's the important control, not any idea about future generations.
Okay, so if we can't rely on the banks to lend to businesses right now, would it be a bad idea to have the government take up that role as lenders to businesses, given the fact that they also have the power to print money?
Well, I think it's just you've got the wrong mindset in the government. I've spent enough time working with bureaucrats and being in the Australian public service for a short while to realise that what bureaucracies reward is conservatism and avoiding taking risks and procedures, obsession with procedures. Drives me crazy, I must say. I don't want people with that mindset determining how much money goes to entrepreneurs like the Elon Musks of the world. I want people to get excited by stuff and take risks and make mistakes. And that is the mentality that you get in banking to some extent. But of course they may take risks with crappy Ponzi schemes right now rather than with worthwhile investments. So I think there's a role for a government creation of money directed at large infrastructure, blue sky research, the sort of stuff the CSIRO should do and is now having its balls cut off by this particular government. So you want the government wasting money by blue sky type research and by infrastructure and so on. But you also want the private sector being innovative about the type of entrepreneurs that it funds. And that's the combination I'd like to see. And that means there's a role for private banking, but once you stop them funding Ponzi schemes, and there's a role for government spending as well, once you get them away from this obsession with running surpluses and see their role as providing infrastructure, welfare, and blue sky research funding.
Now, just moving on to global public debt, Australia obviously has relatively small public debt compared to the rest of the world at around 25% of GDP, whereas the larger economies like Japan, the UK, the USA and China have much larger public debt. Are these countries already bankrupt now?
No, not at all. Again, you're only bankrupt if you owe money to somebody else you can't repay. Argentina can be bankrupt because it has to borrow in American dollars. The American government can never be bankrupt because being bankrupt means you can't find enough American dollars to pay your debt when it's denominated in American dollars. So if the Treasury directs the central bank to send an entry to you in American dollars, they simply increase the indebtedness of the Treasury to the central bank, which is just a double entry bookkeeping number.
When it comes to innovation, we always seem to move forward. I mean, we're not going to go from jumbo jets to propeller-driven biplanes anytime soon, but when we look at economics and human greed, we seem to keep repeating the mistakes of history. So why do we keep going around in circles? Why hasn't the government just learnt and then legislated?
It's really because we have economic theory, which is like that's why I use the example of Ptolemy's theory of astronomy. We have an economic priesthood that I'm trying to undermine with Debunking Economics, that builds a mythical model of the economy that suited, in some sense, a political agenda back in the 19th century, fighting against Marx and the attempt to bring in socialism. That is a neat, plausible, and completely wrong theory of how the economy operates. Just like Ptolemy's theory was, I wouldn't call it neat or plausible, but it worked in terms of giving empirical predictions, but it was completely wrong about the nature of the solar system. Now, if we had that still dominating in astronomy, we wouldn't be talking about rockets to bring back asteroids. We wouldn't even believe that asteroids existed. So we have just with a bad theory, we end up with extremely bad economic policy as well.
So if macroeconomics is so important, then why don't secondary schools prepare the younger generations towards even understanding money or economics? Is it deliberate or just stupidity?
With what we have is we're educating people in a nonsense view of the world, and that's one reason I'm leading this charge by a fair number of non-orthodox economists to try to get us to the stage of having at least a halfway sensible model of capitalism to drive how we think about managing it. Because if we continue managing it using a mythical model, we'll continue ending up in stinks like we're in right now.
So in terms of the way that the world operates today, with China manufacturing goods for everybody, most people I talk to see this as good progress. And yet Donald Trump, on the other hand, was quoted last week saying that what China has done to the US is the greatest single theft in the history of the world. In terms of money and jobs being sucked out, is the China story an example of why fiat currency doesn't work, or is it, as you say, that we just don't understand economics?
It's independent of the Fed. It's a different story to the Fed money issue. But I was in China, and I went to China in 1982. Took a group of Australian journalists over there for a conference with Chinese journalists, and we did a tour of China after that. Took us through the very first free trade zone that China established, the Shenzhen Free Trade Zone, directly above Hong Kong. We had lunch there with the CSR staff, who we had a barbecue in the middle of Shenzhen. With the staff there who were actually laying the concrete for the free trade zone. At the meeting with the managers of that free trade zone, I think I struck the most intelligent people I'd met in China at the time, and I'd certainly met some bright people on the way through. And their policy was to use a particular element of the American trade code that enabled an American corporation to export to a third world country and re-import from that third world country without paying any tariff duty. And they knew that they were exploiting this loophole, which was done as a way of encouraging development in the third world by the American legislature when they passed that particular law. And the Chinese knew if they could use that to attract American business. But they also set up a rule that said that any company that established there had to have a Chinese partner. And I think within either 5 or 7 years, the Chinese partner had to own 50% of the business. So as well as exploiting cheap labour and getting employment for their people, they also saw it as getting Western technology very quickly and forming a capitalist class. So China was incredibly intelligent in how they approached this whole thing and extremely successful in doing it. And it did involve a transfer of jobs out of America, no two ways about it. And it also distributed income from the poor to the rich, because what you had was corporations that had to pay American wages and American conditions and tolerate American rules about environmental damage and so on, transferring across to China, where they paid Chinese wages, which were far lower at that stage than American wages, no taxes, and no worry about pollution controls, and therefore so everything was cheaper for them. So their profit margins grew dramatically, but they deindustrialized America in the process. So Trump's got a point on that particular issue.
So how would we actually see our lives changed if we had real monetary reform? What would the new norm look like, and what would abnormal look like?
Well, the real new norm would be having an innovative society where we're dominated by engineers rather than financial advisors. And that's the world that, in fact, when I was growing up, I was born in 1953. And the focus was always on new technology and innovation and the expectation. I think Richard Glover did a lovely piece about this some years ago, where he said that people thought they'd be working 15 hours a week by the time the year 2000 came about, and we'd all be moving around in flying cars. And what we were extrapolating forward was the rapid rate of engineering and technological progress that occurred in the 50s that gave us the space race and so on. We find 40, 50 years later that we're talking about financial engineering, not real engineering. We've got a bit of innovation going on, but it's despite the fact that money's been going to speculation rather than to innovation. So we'd live in a more innovative, and I think our conversations wouldn't be about house prices, they'd be about the next attempt to bring asteroids back into low Earth orbit. And that's the sort of world we should be living in, because the really defining feature of humanity is its capacity to innovate, and we should be innovating in real technology, not innovating in financial engineering.
Do you believe in a gold standard, Steve, and should it be reintroduced?
No, I don't. No. Gold is regarding money as a commodity, and money has never been a commodity. The only time gold has actually operated as money is during periods like the 100 Years' War in Europe, where mercenaries wouldn't trust notes issued by the king they were fighting for, because the odds were he'd die in the battle. So they insisted on payment in gold, which would work regardless of which particular king won which particular battle during the 100 years that Europe was tearing itself apart. That's when gold and commodities become money, when you don't have a social system you can trust to enable us to use the easier capacity to create money by double entry bookkeeping, which both governments and banks do. So the gold standard, the main advantage of the gold standard was it provided some form of limit on international bubbles and speculative behaviour, because you ultimately had to convert your currency into gold to buy something from somebody else. And Keynes' suggestion back at the time of the Bretton Woods Agreement was that we should create what he called a bancor, which was a form of currency that was issued to countries based on the scale of their economy, which would be necessary for international trade. And if you ran a trade deficit, you'd run out of it and be forced to devalue. But if you ran a trade surplus, there were going to be rules there to force you to spend those bancors back into the global economy and stimulate the global economy and reduce your trade surplus that way. So we need something like that, not the gold standard.
If we had a gold standard now, though, would it work at all, or would the system currently work better? Even though you don't like a gold standard, would it currently work better now if we had one?
No, because again, what we have right now is a crisis caused by a shortage of money, okay? And there's people. The thing people most need to get is money, and money's the easiest thing to create. But it's not being created by the banking sector because it's created too much, and it's not being created by the governments because they have an obsession about surpluses. That's why we're stuffed up right now. If you change across to a gold standard, you've got to create enough of the gold to enable the economy to grow at the rate of growth that it can achieve, when the amount of gold on the planet is absolutely physically limited. I don't think people actually realise how gold is made. It's really quite simple. You take two neutron stars and you crash them into each other, have an incredible explosion which scatters the stuff throughout the universe. It aggregates in the dust cloud around a forming solar system, and in 3 or 4 billion years it becomes gold deposits. So it's pretty hard to make the stuff. And in fact, the total amount of gold, I think, in the planet is measured in the number of swimming pools. So the idea that we could actually run commerce by physically transferring bits and pieces of gold with each other is total nonsense. And therefore what we'd have to have is some certificate-based system based on a notional hold over a notional amount of gold, and you're back in a certificate trusting somebody situation anyway. So I think the whole idea of imagining we could base trade on gold is nonsense. Gold is a speculative commodity that does well when conventional money systems break down, but it is not money.
Okay. But isn't the amount of gold just simply a function of price rather than, I mean, where it is at the moment, you couldn't have a gold standard?
I don't care what price you put on gold. You are not going to enable anybody to make more gold, okay? There's a physical limit. There's absolute fixed supply of gold on the planet. And if you try to use gold as your form of transaction, the only way you can have an increased value of output over time is for the gold price of things to like the gold become more valuable compared to commodities all the time. So you've got to have a rising price of gold to enable constant transactions to take place. And this is the thing about the reason a monetary system works is you can walk out of your house and go down to buy a cup of coffee, not having to gamble about how much money you're going to need to buy it when you get down there. What happens if you find the gold price has doubled since you walked out the door and you haven't brought enough gold with you? The instability of a commodity price system is part of why it doesn't work.
Fundamentally, though, isn't fiat currency issued as debt really just an ancient scam as opposed to currency being a claim receipt on something tangible?
The tangible, money has always been trust. Okay, we've always we're a species which is inclined to trust each other and inclined to work together. And that's what we've lost in the model of this neoliberal fantasy about being competitive, non-social animals. We have to rebuild the system of social trust that we used to understand before we got caught up with conventional economic thinking. The idea of a commodity system is saying I don't trust anybody, I want something physical that I can trust on its own. But that gives you a very inflexible monetary system, and that's you can't have a increase in demand easily in that sort of system. You can't provide gold to somebody who doesn't have gold without putting them in literal debt to you, and in debt in the sense we mean it. You've got somebody to give you gold as a loan has to forego the gold themselves. You get caught up in the world where there are going to be shortages, and where you can't organically expand demand if there happens to be some new discovery that people want to finance. So the get away from seeing it as fraud. Trusting somebody where that trust is justified isn't fraud. It's part of being a decent human being. It's when we've let fraudulent behaviour take over that we start having problems. It's really, and that's what we've done with the way that the banking system distorted itself. But fundamentally, money has always been about trust, not about commodities.
So just getting back to politics in Australia, Prime Minister Malcolm Turnbull said on the 7:30 report in September of 2015 that our economy is not in bad shape. Do you agree with his comments?
No. The economy, I mean, if you read Macro Business, which is a website I recommend, David Llewellyn-Smith on that website calls himself Houses and Holes. That's his acronym. I think it's a great idea because he says the Australian economy has two things. It has holes in the ground we dig up and flog the contents to the rest of the world, and houses we build and drive up the prices on the basis of that revenue. And of course, when the money we can get for selling what we've got out of the holes in the ground diminishes, as it's doing right now, then the sustainability of those house prices becomes totally questionable. We don't have a broad-based industrial structure here, and we haven't managed to lever our enormous commodity bounties in this country into industrialising and diversifying our industrial structure. And that's what we should have done. I would recommend people take a look at a thing called the Atlas of Economic Complexity, by the way, to get an idea of what a healthy economy looks like. This is an MIT research program to look empirically at what gives economies strength. And it turns out that the more diverse your industrial base is, the stronger your economy is. So it's not specialisation, it's diversification that makes you a strong economy. The most diversified economy in the world, surprise, surprise, is Germany. And some more specialised economies that have a narrower base on which they can actually generate wealth, and Australia's classically narrow, are the ones which are fragile to downturns. They don't have adaptability. So we didn't build an adaptable, flexible system. Malcolm, to his credit, is talking about trying to establish that. So on that side, I have a lot of time for him. But in terms of what we actually have right now, we've got a ridiculously specialised and fragile system.
Politicians always seem to talk up the short-term future economically. So can we ever expect them to be truthful if that truth isn't favourable? Do you think it's appropriate for politicians to tell lies if their comments don't, because their comments may become a self-fulfilling prophecy?
This is one of the real problems. I mean, we have a system based on popularity and big man syndromes determining who we vote for, which was very useful when we were back involved in tribal wars, or we were in a totally class structure dominated system where you needed to suppress one social class or another. It's a bit late for us to be still doing that a couple of hundred years into capitalism. So I think we have a political system which rewards narcissistic personalities and then expects them to behave in a socially responsible way. It's just unworkable, and I think we really have to reconsider how we choose people for leadership. The old Groucho Marx comment that I'd never belong to a club that would have me as a member should be a guiding light in how we choose politicians.
Malcolm Turnbull's elevation to Prime Minister has been as a result of a leadership coup, the fifth leadership change in 5 years. Do you think this coup may have been reflecting an inconvenient truth, which is that our politicians are actually struggling to come to terms with what to do with our economic challenges?
Well, they haven't got a clue of what to do. I mean, in fact, politicians, like in England right now, most economists, even most mainstream economists, are agreeing with me the government should not be attempting to run a surplus. I say it should never attempt to run a surplus. Even the mainstream say, well, they shouldn't be running a surplus now, and yet the politicians are beating each other's chest about how big a surplus they can run. So they're completely wrong about how to run the economy, and this comes back partly to that reinforcement cycle you were talking about, because the public has got a mythical view of how the economy operates, believing governments are like a household, and they fall for this argument the government should run a surplus, and then support politicians who repeat that same mythological understanding of the economy back to them. So we're locked in a sort of a cycle of ignorance, unfortunately. And in that sense, the real contributors to that are the economists who've developed theories which, even when they reach sometimes correct conclusions like they're doing right now about being this is the good time to run a government deficit, in general they support a deluded view of how the economy operates, and we have a whole set of reinforced delusions. It's again the best analogy is astronomy before Copernicus and before Galileo, and in that particular world we were never going to get off planet Earth because we didn't believe it was possible to get off the planet. Well, the same thing applies to our understanding of the economy these days.
Have you ever tried to invite yourself over to Malcolm's house for dinner to help him understand what real economic and financial reform looks like? Malcolm seems like an intelligent guy.
He's an intelligent guy. And that's certainly more intelligent than Tony Abbott, and more flexible than Tony Abbott too, which is one of his advantages. But Malcolm still has a problem of being convinced that he's the only bright person in the room. And he does occasionally realise he's not. He realises that in telecommunications. He learned a lot from a few people, actually friends of mine, on that front. But he's convinced he's right to begin with. If he could sit down and say, okay, maybe I'm wrong, then he might get somewhere. But Malcolm's belief has always been that Malcolm can fix all problems. I'm talking from having known him at Sydney University before he became a fairly prominent Australian politician.
So why don't you quit your job at Kingston University, Steve, and come back to Australia and become the country's best treasurer we've ever had? I mean, I'm sure your resume would shit all over Scott Morrison's. Well,
politicians don't get elected they don't become treasurer on the basis of their economic resume, which given the state of economics is not necessarily a bad thing. Australia's a sideshow, mate, I'm afraid to say it, but I always knew that if I was going to have an impact on global economic theory, I'd need to be in America or England, and it's much more useful for me to be here than it is back in Australia.
If we look at happiness metrics today, they look pretty abysmal. There's no incentive to save anymore because interest rates are so low. The cost of living is through the roof. The cost of education is through the roof. Home ownership is only for the brave or the mentally insane. Private debt levels are 5 times now what they were in the 1990s. The birth rate for children out of wedlock is on the rise, as is the average age of marriage. The divorce rate's pretty much the same now, but it was a lot lower between the 1940s to the 1970s. So do you feel that... and we can also be proud of the fact that we've got the highest per capita consumption of antidepressant medication in the OECD nations. So do you think that the millennial generation has a genuine right to be very angry right now? Because it seems to me that the ladder of progress has been almost completely taken away.
Yeah, I totally agree. And I think it's about time the millennials became a political force and started breaking some of these rules that have been put in place by the baby boomers. Because the baby boomers, they're well named, because the baby boomers were born into a population boom and then rode a debt bubble that gave them an economic boom without even being aware they're on the bottom of it. And that because as you spend more, if you borrow more money than the debt's rising faster than GDP, you're actually turbocharging income and wealth and asset prices at the same time. So the baby boomers have risen that as if it can continue riding it forever. But when you get to the peak level of debt like we're in now, the only way is down. And your generation comes along and faces the downhill side of that. And you simply, you face either permanent stagnation like Japan has experienced for a quarter of a century now. They call it a lost decade, it's actually a lost quarter century. Or you have to do a political revolt and unwind what the baby boomers built up. And that means unwinding that debt and unwinding the asset prices that have been driven up by it, and doing it in such a way that doesn't mangle the economy entirely. But yet you've got every right to form a political protest party and undermine those rules. That includes getting rid of negative gearing. It includes reducing asset prices dramatically so we can afford to buy them again. And if we do that, you'll get back to the point where people can actually spend on goods and services rather than having to live on baked beans once they've bought their way into an asset. So yeah, you've got every right to have a political protest, and I'm looking forward to it happening.
Great. My last question to you, Steve, is on Bitcoin, which I believe is a fantastic private sector innovation. It's decentralized and it has the potential to be some form of currency worldwide as an alternative to central bank money. And the blockchain technology, which is behind Bitcoin's success, has many other useful purposes, and we're really only seeing the beginning of that emerge now. Now, I realize Bitcoin is very volatile. It's crashed right down from its original highs, but it's in its defense, it's only 7 years old. And recently we've seen the value creep up from $325 in September last year to where it is trading today, which I think is just over $600. So my question, Steve, is in the next financial crash, do you think it's possible that businesses may switch into Bitcoin because it may end up being less volatile than fiat currencies at that point in time? In other words, is the free market slowly working its way to getting around fiat currencies to the point where fiat currencies could become less relevant in the future?
I've got an ambivalent attitude toward Bitcoin, but not towards alternative currencies. I've got to explain that. Bitcoin, you know how long it takes to verify a Bitcoin transaction at the moment?
Half an hour?
10 minutes. But that's still, we don't want to order a cup of coffee and have it go cold by the time you've paid for it. Okay. So you have to have exchanges that act back between the buyer and the seller to enable that transaction to occur in less than 20, 30 times what people actually would tolerate for transactions. And that alone is a technical reason why Bitcoin is just too energy intensive, both in producing the Bitcoin and then in verifying the transactions. So I think that particular side of it means it's not suitable for transactions, and the volatility as well. The fact that the price can vary so much. I mean, I made a line about going out to buy coffee and not taking enough gold with you. I was thinking about Bitcoin in particular as well. If you went shopping with it, you don't know what you're going to need to go shopping that day because the volatility is too high. And it's with the reason Bitcoin is modeled on gold in the sense that there's only 21 million Bitcoins that can exist. So like there's only a certain physical amount of gold on this planet that can actually be mined. But it's a fallacious analogy because for a start, there's no thing stopping somebody else producing another version of Bitcoin. There's about a dozen or so blockchain currencies in existence at least right now, probably more like 100. God knows how many there are. So you can't produce new forms of gold. You can produce new forms of digital money. And the transaction costs in Bitcoin, I think, are just too high because they tried to emulate gold by making it hard to mine in the same sense that gold was hard to mine. So it's that side of it that I'm critical of. But I have despaired of central banks ever understand, except for this, the only bank we've got time for is the Bank of England as it happens, but central banks, particularly the Federal Reserve, are still making stupid mistakes about the nature of money. Politicians are still making stupid decisions about running surpluses, and I just don't think we're ever going to see ourselves intelligently working out how that monetary system works. So in this sort of world, I think I have to rely upon the commercial sector to start developing alternative parallel currencies. And there's a couple of parallel currencies that I'm aware of, one I'm actually going to be consulting to in future, that are trying to develop a different way of backing currencies, not gold, not Bitcoin, but enabling alternative currencies to exist that give us that sense of trust and enable transactions to occur. Otherwise, we'll be stuck in a permanent state like Japan. So I'm a fan of parallel currencies. I don't believe Bitcoin's got the right design, but I do believe we have to rely upon the commercial sector to invent new forms of currency to enable us to get out of the complete miasma that the private banks on one hand and ignorant governments on the other have done with our current monetary system.
Great. Well, thanks for that, Steve. That concludes today's interview. If you want to learn more from Professor Steve Keen, I suggest you look him up. He's all over YouTube and he makes regular appearances on the Max Kaiser show on RT. And most importantly, go out and buy his book. It's available at Amazon and it's more relevant now than ever before. Professor Steve Keen, pleasure having you on. I'd love to have you back sometime and keep up the good work.
Thanks, Marcus. Okay, bye-bye.